Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 21st of October at 10:30 UAE time, Monday morning, and Brent crude oil is trading a little bit up this morning. We're seeing a move above $73 a barrel as Brent and the oil markets start to digest, let's say, the news of the weekend a little bit more heated, and so the markets seem a little bit more elevated. But let's kick off, as always, Monday morning with Omar Najia, the global head of derivatives at BB Energy. Omar, all the noise of October, and we're kind of back where we started. Has this market drained out the geopolitical risk premium that we saw elevate everything through the month of October?
Well, I mean, I'll put it a different way. I think this
Yeah.
market understands the geopolitical risk premium, right? So everybody was jumping up and down. 48 hours, 22 minutes. They've picked the targets. Here we go, blah, blah, blah. And what's
They're
happened is
saying the
actually,
same this morning, actually, all the headlines that
yeah, but it's fascinating. So they're saying all the same. Oil, I mean, is not moving. Uh, I think last week, we started off the week at like $75 and we closed the week at 69. So it got massacred. So, and notice the news, right? So now we're like, they've picked the targets, they're coming in, they're going to launch, I don't know what, and, all this kind of stuff. And then what gets quote unquote leaked is the attack plans. And then you've got the Americans saying, we're going to investigate how these plans got leaked. So you can see in the background, they're like, well, they would have attacked, but obviously the plans got leaked. So now we've got to investigate why and how. So they're not going to attack until, all this kind of stuff. So, it's what we call a nothing burger. So unless Israel, and then you have, they've sent over a second, you know, radar thing, and I don't know what, and it just get. I mean, it's laughable. So I think basically what people need to understand is this is not like a big kind of arrow kind of attack here and bomb here and do this. This is going to be a war of attrition, a very long war, precisely the kind of wars basically that the G7 aren't equipped to fight, exactly the same as we're seeing in Ukraine. So it's not going to be over tomorrow. It's not going to be over in a month. It's not going to be over in 2025, and probably not until at least 2026. So I think basically the market realizes that. I think the market has to work in terms of it has to see stuff to believe it, and any of this geopolitical premium is stuff that we're likely to see sold. The market is weak, and until we get to the U.S. elections, I mean, I think this administration doesn't want to see anything happens until the election, and so all the leak stories and all this kind of stuff. Once Trump gets in, then you're talking about January. And once they line up all their ducks and all the rest of it, you're definitely talking Q1, maybe Q2. And then the question is, does the US want to kind of, commit suicide and jump off a cliff like the dodos did, and basically risk, the global economy, the US dollar, bond markets, massive debt, all the rest of it, and say, yes, we are going to strike Iran because it's, a regime of I don't know what and blah, blah, blah. I'd bet against it. But, I'd always bet against, people who argue that money isn't important or that people who have money are stupid. So I'm betting no.
Well, let's set up Russell Robertson, Chief Commercial Officer at Gulf Mercantile Exchange, with that thesis of the component part of this geopolitical equation to me that doesn't get mentioned a lot is China. If Israel was to knock out Iran's oil infrastructure, that would have a big impact on China, the rising power in the world. I'm not sure Tel Aviv would want to do that. But Russell, I wanted to get your thoughts on where is China going? We're seeing reports out of Reuters today that yet again, massive stock building in China.
Yeah, I mean, stocks are quite large. They're maybe plus 150 million barrels have been added to Chinese storage this year. So there's a huge buildup of oil over there. And you do hear a lot of negative press to say that Chinese demand is collapsing, is quite strong rhetoric sometimes. But when you really look at the actual data, I mean, they're still looking at late 4% of growth next year. And when you speak to clients, there's definitely still an appetite for growth. It probably won't be growth that we've seen in previous years, but we forget that growth is still plus numbers. So I think that's definitely interesting. I sort of agree with Omar actually on some of his points. I think ultimately this is all coming down to inflation, in my opinion. I mean, if you damage some of these oil supplies, you're ultimately going to increase prices at some point. There's obviously a lot of scenarios in how they could do those attacks and whether they attack refineries or oil supply or internally, externally. But ultimately that increases oil prices, which we know is bad for inflation and which is something the US is particularly worried about at the moment. So I agree. I think it's going to be very difficult for anything to take place before the elections. If you see the price at the pump go up in the US, it's going to be terrible for anyone in standing for elections.
Let's go to Algeria with Shoaib Boutamin, Energy Advisor and CEO at Ranadrill Consulting. Shoaib, as we look at all of these things this October, which started the month actually with OPEC, that was sort of September month rather, that OPEC Plus decided to not to proceed with their output increases from October 1st and now postponed to December 1st. So once again, we're kind of not only on the doorstep of a US election, we're also on the doorstep of OPEC Plus having to make some decisions and announcements regarding their next move. How do you think they're looking at all of these things, and how would they be categorizing what they prioritize here in order to make their next judgment?
Yeah, good morning, Sean. Good morning, everybody. I think I have heard a lot that that OPEC Plus members have committed a mistake last June by taking decision to put a plan on their cards, but voluntary cards in 24-25. But I believe the mistake has been made last September, when they really did not really act the time they did not really executed what they decided before. That time they gave, I think in September, they gave a negative sentiment to the market and to the investors also. So that's why we have seen how the prices, oil prices started to drop. I think that the OPEC Plus at the moment have to change their way of thinking about how to export their crude oil. But I think they have to think out of the box, and they think on how to valorize the barrel of oil and how to invest in petrochemistry and to be really a little bit independent from the oil prices globally and from geopolitics. I think that OPEC Plus at the moment has not too much to do, because it's really, we are depending to many factors, and especially fundamentals. When we see the China demand last August just dropped 500,000 barrels per day in August year on year. And for a fourth consecutive month, I think that this is a strong sign that fundamentals of the market are very, very weak at the moment. And I think that, as you know, that China is the main driver, is the biggest importer of crude oil in the world. And I think this is a strong sign to OPEC members that fundamentals are still very strong. And at the moment, I say, if the OPEC Plus decided just in September just to pump 180,000 barrels to the market, I don't think that will affect a lot, but at least they get a market share. I believe that was a big mistake from the OPEC Plus to not resume pumping oil last October, and I believe it will really affect and gave very negative sentiment to the market. What I can say about the OPEC Plus at the moment is very tough. It's very difficult at the moment, because we have some geopolitical issues, and we have escalation in the Middle East, and we have let's say recession of many economies. Let's say China, what's happening in China, not only on China, but let's go to European Union. What's happening in Germany, in France, and the UK? They are in a recession, and they believe OPEC Plus members at this time, they cannot change the world. They cannot change many things. They just pump a little bit, just to run behind the market share That's it. For the prices, I believe, even if they reduce million barrels per day, 500,000 barrels per day, that will not affect a lot, because we have in other parts, we have a recession and we have very, very slow pace of let's say, economic growth in the world.
Omar, we obviously look for signals as to, where we're going next, and as you mentioned, U.S. election. But I'm wondering, I wanted to get your thoughts on what is gold telling us? I mean, oil is bouncing up and down, trying to get away from $70. Meanwhile, gold is just rising up the top of Mount Everest and keeps going, now trading today above $2,732.
Yeah.
What's the message there? What's the cuckoo in the coal mine telling us about gold?
So I think the misconception, I agree with what Russell was trying to say. There's a misconception that, things are in recession and I don't know what, and prices. Forget about labeling stuff. All markets are heading higher, right? Except for oil. Everything. Gold, silver, wheat, corn, S&P, NASDAQ, FTSE, CAC, German indexes, Swiss indexes, they're all going up. Real estate, everything's going up. It's not going up because there's a recession, or not a recession. It's going up because of inflation, because the US was adding about $1 trillion every 100 days. And I don't know if you've seen like the tweets.
And regardless who wins the election, it seems that's going to continue.
Yeah. And you see the tweets from Musk about basically, the US going quote unquote bankrupt, but they don't go bankrupt. What they do is they print more money. They devalue the value of the US dollar. I mean, it doesn't take a genius. Go back to 1940. You want to buy a burger, it costs you 10 cents. Now it costs you $10, right? Same dollar, same burger, but you're paying more. The reason is not like, recession or GDP or anything like that. It's to do with inflation. It's to do with the debasement trade. Why? Because
and oil is not a hedge
is
for
so
inflation.
Massive. Of course not. Oil is consumed. You can't hedge with something that's consumed.
But on the future side.
No, you can't do that. It's oil is a consumable thing. It's not something that you can store and wait and whatever. You can't do that. Same with all, like grains and livestock. You can't invest in a cow and store it away and say that's a hedge against inflation. It's a cow. It needs to be eaten. Oil needs to be burnt or made into petrochemicals, whatever. So basically what you're going to see is asset prices, hard asset prices, go through the roof. And it beggars belief. We're already seeing it, and people still don't want to believe it. They're like, no, no. It's going like this. Now the problem with oil, oil is always going to basically lag the other markets. Why? Because it's the one that's most tied to geopolitical risk. Believe it or not, there's a lot of influence on the future price of oil. Demand in terms of, recessionary or growth is tiny. Global oil demand for physical oil is 100 million barrels a day, 100 million. The futures markets, the derivatives markets trade billions. It's a financial market. So basically, when you have a financial market, it can be influenced by people who want to push the price down, to push the price up, all this kind of stuff. Right now, it's a push the price down, no matter what you think, no matter what China does, no matter what, growth or whatever it is. The pressure now is to the downside. If and only if you have something that changes that, like a strike on Iran by Israel, then everybody is going to shut their short positions and go long, and that's going to cause a massive spike to the upside. But oil is a financial futures market that has basically trillions of dollars in it. It has nothing to do with the physical, 100 million barrels a day that trades. So oil is going to lag at some point. Oil is going to basically absolutely roof because everything else is going to roof. Trump is structurally negative for the oil price. Why? Because he's not green. He wants to drill. He wants to do. But again, they might keep the price down for a little bit. But going forwards, the thing that's really going to drive prices is inflation. So oil will be, when oil starts to rise, we're all stuffed, we're all cooked.
We're all.
Okay,
You
because
won't use
everything
that
else will
word.
become very, very high.
Still a children's show. Russell, unlike just a little bit playing of words here, but ultimately, oil is something you can store, and oil traders have made fortunes in recent years by doing so. When the market outlook is towards contango, that word is coming up again. Your thoughts on the outlook for the structural change of this market, that we could move towards contango going into the new year?
Sure, yeah, I love Omar's passion. I hear him as a person with background of financial markets. I hear what he's saying. In my particular market, in the Omani market, we are quite physical in nature, so we do have some slightly different fundamentals to what you might see. But yeah, the curve has definitely changed. We've flattened a lot in the last few months. In April this year, when oil was at 90, we had a contango, a backwardation of like $8.50 almost. The beginning of October, it was $1.37. So that's changed a lot. And I was expecting to see maybe sneaking into contango. I think we did in some of the Brent markets, it went slightly, but for Middle East, more physical generated futures contracts, we haven't seen that. And actually, as of yesterday, we've moved back down to like about $3. So that's very much the same on par average as what we've seen last month as well. So curve is moving slightly, but it's more to do with the fundamentals and supply and demand, and what we're talking about here with OPEC and things like that. And obviously China's demand is having an impact, but it's still in a range.
Shoaib, I wanted to get your updates on where development opportunities are in North Africa, and obviously in Algeria in particular, OPEC plus country, OPEC country. Here in the Gulf, we are adding as much capacity in many countries. Oman producing near capacity, UAE going to 5 million, Kuwait are starting to join and trying to rev up capacity. Where are the North African OPEC countries? We know Libya has been through a somewhat tumultuous period, with the politics there continuing to be quite volatile. What about Algeria's outlook for further investment in new capacity, oil and gas?
Oh yeah, Sean. I think Algeria is dependent to its client, and the main client of Algeria is Europe. And the Europeans at the moment, with the natural carbon 25, they are looking for natural gas. They want to invest in natural gas, not too much on oil. So Algerian production of oil is stabilized like around 920,000 barrels per day. And Algeria is all the time committed to its quota among the OPEC plus. So when we see to Libya, for example, Libya, we have some stability of supply of production at the moment. You know, we had like some outage last few months, but at the moment there is some stability. As they increase their production, I think they are more than 1.3 million barrels per day at the moment. So there is good production in Libya at the moment. But all the time we say the instability in Libya is all time feeding conflict, feeding split among let's say the companies producing oil in the country. If you go back to Algeria, I think we are committed to the European Union market because they are our main client. So Europeans at the moment are looking for natural gas. They are looking for renewable energies, and we have seen the last week we had a big exhibition in Algeria in conferences, NAPAC. And we have seen many countries from European Union, from SNAM. We have 2 companies from Italy, 1 company from Germany, 2 companies from Algeria, and 1 from Austria. They signed an MOU to provide hydrogen to European Union from Algeria. And I think this is very interesting. This is the new a new challenge for many countries, for North African countries, because the Europeans at the moment, they are looking for everything green. And when we say green hydrogen, North African countries have this potential. So at the moment, we have also some 2 companies, giant companies, majors, ExxonMobil and Chevron, have signed also 2 MOUs with the Algerian government here, and they are looking to invest in natural gas in Algeria. And it could be something oil, but the interest is all the time natural gas. and they believe they find a big potential in the country. Let me remind everybody that Algeria owns the third biggest reserves of shale gas in the world. At the moment, I believe Algeria is committed.
Can it attract the capital? Can it attract the capital to unleash that?
Yeah, I think there is nothing really released officially. Released. We don't know the details of what happened really signed, but I believe there is a big, huge interest. Maybe somebody can ask why these foreign, let's say, major companies are interested in Algeria. It's very simple. The main client of Algeria is European Union. We provide natural gas, most of natural gas to European Union. So these companies, they want to invest in Algeria and to provide that natural gas to European Union. My idea is all the time to say it's time also to attract foreign investors to the countries, to valorize natural gas, to valorize oil among the OPEC plus OPEC countries or the North African or the producing natural gas. We need to valorize natural resources we have. We need to bring the majors, to bring the big petrochemistry companies in the world to these countries. We keep them invest here, and I think we can add value to local economies and to the regional economy.
I suppose the challenge there is you've got to put more upside for the international companies on the table to bring in their big dollars. That's always been a challenge in Algeria. Let's go to the survey question and get a view here on the room. Oil prices have once again lost all their geopolitical risk premium as demand weakness trumps supply risk. We've seen as we've gone from early October, I think it was October 1st when we had the start of this latest round of Iran-Israel face-off. We still haven't had the sort of bookend of that. It's the latest news on the weekend. It's coming this week. But nonetheless, oil prices aren't waiting around for it, and the geopolitical risk premium has drained out of the market again as demand weakness trumps supply risk. Agree or disagree with that statement? Omar, another sort of part of this demand weakness as we look for sort of tea leaf reading signals, we had the Chinese the Chinese steel demand outlook will this year account for less than half of the global total for the first time in 6 years. And we had the CEO of iron ore, the CEO for iron ore at Rio Tinto, joining this language of peak China. China's at the structural peak in terms of steel demand. If China's at the structural peak in terms of steel demand, is that sort of de facto it's somewhere near peak on its oil demand? How do you see that connectivity? With the same weekend, we've had the Aramco CEO out saying, no, chemicals is going to make the new continued growth in China. Your thoughts on that argument and its relevance for the markets?
So I think you have to be very careful with where you get your news from, right? So
I get it from, I'm looking, I know you're a subscriber of the great Bloombergian empire.
Yeah, but you got to be very, it's very confusing because first of all, China was like absolutely stuffed and the real estate was dead and the market was dead and everybody's jumping out of windows. Then it rallies 30%. And then everybody kind of looks at it, no, but we're still selling and now they're going to sell even more and it goes up again. And now it's like,
You're talking about the Chinese equity markets.
Yeah, Chinese equity markets, right? So if you look, I have a very interesting statistic for you compared to China and steel. Yeah. In 1960, world GDP was, the US GDP was 40%, 40% of world GDP, 40, right? Today, 2024, guess how much it is?
22.
15.
Ooh.
Now that's telling you. So are we going to see these headlines on like Forbes and Times and Bloomberg saying US GDP is collapsing as a percentage of world GDP and we're going to see everything collapse? No, of course not. So basically I would take all this stuff to do with China with a grain of salt. If you're buying equities, I would buy the Chinese ones, not because I love China or because I don't like America, but simply because in terms of valuation, they're extremely cheap. and the US ones are extremely expensive. So it's not to do with, it's to do, I mean, what again, I think what decides this stuff is capital flows. And capital is a lot of things, but is not stupid. So I think you're going to see more and more capital head away from Western markets, G7 markets, and go into Eastern markets, BRICS markets, that kind of thing. And I think, again, you're going to see, this is why I think you're going to see more, the world concentrate more on hard assets rather than paper. The G7 are made out of paper and debt, nothing else. Okay. In terms of real commodities, hard things like, you know, I don't know, gold and silver and copper and stuff that they actually make, you know, and that kind of stuff. So you've got to basically look to hold hard assets. So I'm not a China bear. I'm a China bull, and I tend to view, you know, the news. I mean, all news is controlled by about 10 people. All the news that we see, Reuters, S&P, Bloomberg, they say the same thing. And it's something that's being sold. I mean, I remember when we first had Bloomberg, they used to just give you the stories. Now they curate them for you. This is what you need to know before you start trading. I mean, I don't read the stuff anymore. So, because if you need to know this stuff before you start trading, then you're doing exactly the same
What you
stuff
need
as
to know
everybody
before
else
you
does.
start trading is the
Yeah.
bloody Daily Energy Markets podcast.
Yeah,
That's it.
exactly.
End of
Exactly.
story.
And I
Put your
agree.
Bloomberg
I agree.
away.
I agree.
Russell, your thoughts on that? I wanted to get your view looking forward to what does this market, if one was to try identify some bullish sentiment. As we say, we're closing out October. We had the big sort of geopolitical risk premium take us above that $80 mark where we were most of the first half of this year, but we've dropped back to the 70s again. Is there anything there that you'd see a North Star that could bring some upward momentum to this price other than these shock moments of geopolitical risk? We're going into the end of the winter in Asia, the China New Year. I mean, typically a good buying period, solid demand for Asia. Your thoughts on any bullish elements you would point to that could lift up this sagging oil price that seems to love 70 more than 80 these days?
Yeah, I mean, I can talk about the performance of our contract. So we're
Yeah.
trading December barrels at the moment. I think the market was very quiet in August, so the liquidity dropped a lot across all derivative contracts that I saw. As of last night or Friday night, we had open interest of over 20 million barrels of oil on our contract. I mean, that is a number that, like for like basis on a daily check, it will take you back into the third quarter of 2018. So these are quite significant numbers. And we all know that Oman is very preferable to the Chinese economy. So I'll give you that one and say, hey, why are they loading up now for end of year? Is that an end of year cycle, or is that going to suddenly change next month? I don't see it.
Well, you would think they must have some concerns about the geopolitical risk in the Middle East over the last weeks and months that they're quite vulnerable to.
Well, they are, but a lot of the things that you look at would actually be quite bullish for some of these Middle Eastern grades that are coming out. I mean, Oman, Abu Dhabi grades, stuff like that. They're not impacted per se. Their value will probably go up, if anything. Demand for those things will go up. Yes, and I guess you can say that that's an impact on the Chinese refiner to buy those, but it has an impact then onto the crack spread. So their products should theoretically become more valuable too. So we're coming, like you say, we're coming up to the winter, low gasoline season in China. So we'll see what the refiners are going to do over the next month or two. But in realistically, they've already bought into that over the last few months because, as I say, we're trading December loading now. So I think we've already seen the growth happening. And as of the end of this month, we'll be looking at what they're doing for the New Year cycle, which does tend to show a trend for the year ahead. So it'll be interesting to see how that happens.
Troy, last word for you this morning, going back to where we started. Do you think OPEC Plus will continue with its plan to increase supply in December? I mean, we've seen that story. It's on an or, it's more of a connecting point that the Financial Times article from September, when they announced through Saudi sources that a price war, a market share war might be on the cards, which would indicate a willingness to continue with the plan to increase. Your thoughts on whether OPEC will actually do that?
To be honest, I don't know what they will decide, but from my opinion, my point of view, they have to do it, because if the OPEC Plus members will not pump more oil to the market, somebody else will be an alternative. It could be someone from the OPEC Plus members, I don't know, Iraq or Iran or other countries, or even the non-OPEC countries out of the OPEC, because the non-OPEC production increase, they gain like 1.5 million barrels per day. I think that the OPEC Plus members at the moment have to decide to take, let's say, I think my advice to them, maybe if they hear it, when they take a decision to pump oil, they have to take it, because if not, they will like spread a negative sentiment to the market, and will happen what happened to us last September. Let me remember last June, when the OPEC Plus members decided to, they put a plan, oil prices just went steadily. They were like $83, $3. Prices didn't drop. But last September, when they decided, they said, oh, okay, maybe we will, let's say, wait a little bit and we'll resume pumping into December. At that time, the prices dropped, I believe that gave very negative sentiment to the market. And I believe they have to resume pumping, just because there is a market share. If they don't take it, somebody will take it. And the second thing, there is some split inside the OPEC Plus members. Some members, they have capacity to increase production. I think they have to make it, at least to calm down, and let's say to repair what really happened before last September in the OPEC Plus meeting.
Okay, we'll have to wrap it up there. This room agrees that the oil price premium is drained out and demand weakness is trumping supply risk at the moment. At least it did last week. We'll see what happens this week. A whole nother set of factors to consider. Omar Najee, as always, Global Head of Derivatives, BB Energy. Thank you so much for your thoughts today. Russell Robertson, Chief Commercial Officer at the Gulf Mercantile Exchange. Thank you so much. And Shoaib Boutamin, Energy Advisor and CEO of Randall Consulting. Thank you so much for your thoughts. Have a great week, everybody. Brent crude oil sort of little unchanged, above $73 a barrel this Monday morning. Thank you.
Thank you.
Bye-bye.
Cheers, guys.